Welcome back to Retirement News Online. I'm Scott Drake. Well, it's for certain that taxes don't stop when your paycheck does in retirement. In fact, tapping into your retirement income creates a lot of opportunities and challenges with regards to taxation. My guest is John Farmer in Mesa, Arizona. John, welcome back. So when somebody retires, all these assets that they've accumulated now has to be turned into income. And, we're talking about 401ks and IRAs. Why don't you begin by talking about 401ks and how they're taxed?
Well, the 401k is basically a government program that's designed to let company employees defer their taxes for a period of time. And generally that's through retirement. As with any government program, you're going to end up with strings attached. And these strings come in the form of, like, if you pull any money out of your 401k prior to 59 and a half, you're going to be penalized 10%. And if you leave all your money in your 401k until you're 70 and a half, the government says, you haven't paid us any taxes, so now you have to pay us taxes. So basically, then they force you to start taking money out and paying taxes as ordinary income tax on that type of program. So if you look at and think about it, if you're a farmer and you have a bag of seed, and you could plant that bag of seed and get 100 bags of seed. Now, if you were that farmer, which one of those two scenarios would you prefer to pay taxes on? The 1 bag or the 100 bags? Most people tell me they prefer the 1 bag. And a 401k is very similar to that, in that you put your money in, it grows, you pay on all of it. Or you have the opportunity to pay taxes on 1 bag, and then everything else becomes tax-free. So if you look at the 401k, there's several alternatives available to you that will give you the ability to create a tax-free income in your retirement, whereas with the 401k, you're always going to be taxed. Now, there is one area that I would recommend with a 401k that you definitely take advantage of, and that is the match that the company makes. If the company matches 5%, you match 5%. That anytime after that, your funds, anything over and above that 5%, should be redirected towards something that would give you a more of a tax-free or tax-reduced income in your later years.
Well, John, finally, as we wrap up, talk about how life insurance can be used to create tax-free income.
Well, life insurance is a very unique tool in that there's a lot of different things. You can use it for college funding, you can use it for retirement, you can use it for long-term care. There's a number of different areas that life insurance can be used. Now, you put your premiums into life insurance after tax, and all the return that you get from it comes out as an income tax-free benefit for you. And a good example I have for you would be, I have an attorney, a doctor who is a client of mine, actual client, and he's putting in $1,500 per month, $18,000 a year. He started at age 38. At age 58, he stops contributing money. He's put money in for 20 years. At age 65, he'll be able to pull out an income tax-free death benefit of $125,000 for the rest of his life. And if he dies at age 85, his wife is going to end up with an additional $850,000 in death benefit. So there's a great opportunity for creating tax-free retirement programs, tax-free income from life insurance.
Great, John. Thanks again.
Thank you.
My guest has been John Farmer in Mesa, Arizona, and you're watching Retirement News Online.